Thank you so much, and I'm glad we have got this going because I'm really excited about what we're about to talk about today, and we have a big team here. That you're going to hear from a lot of different voices, and that sort of reflects that we don't always all see the market that we're looking at the same way. Partly because we're looking at it through the lenses of different companies, and we have different kind of biases and different kind of analysis that we bring to it. But this is what we're going to cover: the big trends that are shaping consulting and IT services, the companies that have, well, broadly how the companies have positioned themselves, and then of course which ones will outpace peers. So here's who you're going to hear from. And typically when we show this slide, we include a list of all the companies that the presenters, that the analysts cover. We can't do that today because we've got such a big team, but you're going to hear from each one of them, both about specific trends that are happening, things that are happening broadly in the market. And then at the very end of the presentation, we're going to each go into detail on a particular company and why we think they're just going to be interesting in 2026 or why they're going to outperform their peers. And I will say, if you have any questions throughout this, please just throw them in the Q&A, and we will address them either as we're going along or at the end. We cover all the companies in the IT services and consulting space. So from sort of McKinsey on one end of the spectrum to Wipro on the other end of the spectrum. We have a couple colleagues that also cover the U.S. federal IT services space as well. If you have questions about that, please feel free to ask. And so with that, let's jump into the first part here, sort of the macro trends. You're going to hear from a couple of my colleagues about a couple of these trends that are on the right, but really the one on the left is the one that I think when we talk about shaping demand for consulting and IT services over the next 5 years, it really is a question of what's going to happen with enterprise AI. Is there going to be adoption at scale? Are we going to start really truly moving from pilots to scale? And then you see the list at the bottom there: data readiness, governance, and all the rest. Those are clear areas for IT services companies and consultancies to provide those services around taking enterprise AI adoption to scale. I think it's on the next slide that we're going to show sort of a forecast going forward for the next 5 years. But I think it's unquestionable this will be the most important area that we're looking at in terms of shaping the demand for consulting and IT services. Now, how each company individually reacts to or positions themselves or takes advantage of that change and that demand, we'll see. But this is unquestionably the biggest thing that's shaping the IT services in the consulting market now. And with that, I'll turn to Boz to cover a few of the different. Boz, I think you're doing commercial models, right? We'll hop into that next.
Yep.
Excellent.
Thank you, Patrick, and thank you everyone for joining us today. So we'll spend a moment just to touch on probably one of the most important pieces of the evolution, which is commercial models. And why I say the most important is because at the end of the day, at TBR, we look at those companies and we try to answer the questions: how are they making money, right? As a result of using all these technologies that have gone through the various ways of ERPs and cloud and now AI and whatnot. So what we're starting to see is, and we're probably not in the last 3 months in 2026, but probably 18 months prior to that, is the greater discussion around outcome-based services, right? And that has been kind of the shift from the traditional times and materials model. And outcome-based is not a new concept, is not a new trend, but the advent of Gen AI and now agentic AI has certainly put some more pressure on the professional services organizations, how they go to market, how they bringing their portfolio offerings. And we're hearing increasingly more about productizing services. What does that mean? What does that look like on paper for the companies? And is the outcome-based services the right commercial model? Is fixed price the right commercial model? What does the future looks like? And I think we are in that transition period between times and materials and more of the outcome-based services being used as a marketing tool from what we are seeing in the market from the vendors, and kind of like testing and trying what's next in the future, maybe in the next 3 to 5 years, where we do believe there will be probably a greater share of fixed price models or a combination of fixed price and some outcome-based services. But what's happening right now is in the market is that some of those vendors are really testing, and they're testing across various domains, from how they skill their talent, the types of people that they are, acquiring or training or reskilling, and to the portfolio offerings and how they actually bring it to market as either directly to the customers and or through their channel partners or using marketplaces and whatnot. So it is a very rapidly moving target, so to speak, for the companies that we track. And it's something that they're all grappling to crack the code and what's the right mix, especially if you think about in the multi-agent ecosystem where the professional services vendor has its own agent and the client has their own agent, and their top two or top three ISV providers bring in their agents because of systems of records and ERPs and whatnot, systems of engagements, have their own agents. So now you have to deal with 4 or 5 plus different agents. So how, as an organization, you create the right pricing and commercial model? It's something that organizations continue to grapple with. Again, we're starting to see some efforts being, involving an outcome-based is probably the first kind of a line of defense for those companies to have the conversation. I think the bigger opportunity for those companies to start looking into is how transparent they are and how much they're actually showing to the client. What exactly clients are paying for today. Are they paying for people, for human effort? Are they paying for intelligence enabled by the bots and the agents, or are they paying for a trusted judgment delivered by the people as well? So that's the big question. But these are some of the efforts and the puts and takes that we are starting to observe in the market as AI and agentic AI is really disrupting the business model, and the commercials are really the one that are really being looked at very closely for most of the vendors. With that, we'll turn it over to Kelly to have her speak to the next trends that we're seeing in the market. Kelly, over to you.
Thanks, Boz, and thank you all for joining today. I wanted to chat a little bit about the SaaS evolution that we're experiencing in the market. The SaaS market is currently undergoing a bit of a shift owing to the advance of AI technologies, which is changing the way that enterprise clients are using those SaaS tools. AI is becoming increasingly embedded within those tools, pulling on the AI models to help embed more intelligence and predictive outputs. While there is speculation that the SaaS will be discontinued, it won't be as prominent of a player moving forward following this use of AI. In the short term, at least, it will remain in use as it's still working with the AI. It's still an essential piece of how a lot of the enterprises are operating at the moment. SaaS remains essential as a system of record and governance layer for most enterprises, but its gravitational pull is weakening as modernization changes, and the AI readiness is changing how clients are looking at their budgets and how they're engineering the entire environment and how they're working. The incumbents are responding by restructuring their product organizations, accelerating small model development, and deepening data harmonization efforts. They're really trying to leverage the autonomous pieces, the automation, the agentic, but they're still keeping that same structure, just changing how it's pulling in new data and the results that it's actually getting. These moves position AI as the new source of differentiation, but they're not eliminating the need for the SaaS architectures that anchor identity, compliance, and structured workflow logic. So we're still going to see the use of SaaS in the short term. I think it's just going to be more and more aligned with those AI models and pulling more. So in a sense, it will be able to do more than it has and provide more data and insight than previously expected. Jill, did you want to chat about one of the other topics?
Yes, thanks, Kelly. So another thing we're going to see is that persistent new and ongoing conflicts in the Middle East will cause headwinds in manufacturing and industrials, agriculture, and of course, travel and transportation, as these enterprises navigate supply chain and logistics challenges. In conjunction with rising geopolitical concerns, such as digital sovereignty in Europe, we anticipate this will give way to a rise in consulting, as clients realize these geopolitical and macroeconomic uncertainties are perhaps longer term than initially anticipated. We also expect these IT service companies will continue to build out supply chain consulting, supply chain optimization, and data analytics. With that, we'll go to the next slide.
Excellent. So what you're seeing here is the new TBR IT services market forecast. We haven't done them in the services space ever. This is new. We just last week rolled out one for the U.S. federal government IT services. And so we have this one, which is IT services broadly. We're also going to do a consulting and systems integration market forecast. So this hasn't published yet, so you're getting a little sneak peek of what we're going to see. And the forecast itself, this is sort of the baseline forecast, and then within the market forecast report itself will include different scenarios. What could go really right? What could go really wrong? How could we see a back to double-digit growth in IT services and consulting? What are the factors that would lead to that? So you'll see different scenarios all spilled out in there. But what you see on the right are sort of the four key drivers that we think are gonna have an impact on the demand for again, we're still sticking with the demand for consulting and IT services. These will provide that opportunity for growth around IT services, around consulting. Of course, that's growth. As you can see, that growth not projected to be very high in the single digits. So what we're talking about is growth for the companies that are able to take advantage of all those trends on the right: physical AI, agentic AI, governance, risk, and compliance, and of course, cybersecurity and sovereign. Boz, did you want to make any, or Elisa, any other comments on this slide before we jump to the next one?
Elisa, do you have a comment? I'm happy to chime in. I know that Elisa's been spearheading a lot of that, but happy to chime in, Elisa.
Yeah. So just want to add here that the graph that you're seeing is for the 30 vendors that we publish in the IT services benchmark. So those 30 vendors, we have calculated, made models of their growth rate through 2030. Those 30 vendors, they collectively account for approximately 30% of the IT services market. So for those vendors that we cover in the benchmark, we are projecting that the CAGR through 2030, from 2026 through 2030, will be around 4.5%, whereas the overall IT services market will grow at a CAGR of 6%. So those 30 vendors really shape 30% of the market.
Elisa, I was just thinking about it, looking at the graph and what Liz just mentioned in terms of the growth projection. I mean, we're talking like mid-single, maybe upper single-digit growth, potentially expanding, but this is not the growth that some of those companies are accustomed to. So I think that the critical element here will be to think about how vendors that are actively participating in the IT services market adjust, and would there be a vendor that actually is going to break that barrier and start capturing, low double-digit or even mid-teens growth, some growth that some of those companies experience post-pandemic. So it is an evolving market. Obviously, there's a lot of hope around AI driving that growth. I think there'll be some bumps on the road as we see fit. Obviously, as the market evolves, likely there'll be some consolidation and the landscape will start to look a little bit different from where it is today, maybe in the next 5 years. But I think it's an opportunity for some of the vendors that have a little bit more mature view on what it takes to make that pivot, into the future. Would it be, developing products? Would it be selling, solutions versus services? Would it be partnering differently? All these pieces are on the table, and we're starting to see some indications from some of the vendors that are placing more strategic bets as we speak. But I think the mid-single-digit growth in a very mature market, certainly they will face some headwinds, especially as Wall Street typically expect a consistent, perpetual double-digit growth. So I think we're going to see some more pressure in the short to midterm before winners start to break out with some of those bets that I mentioned starting to pay off post 2030.
Yeah, and thank you, Boz and Lisa. And Lisa, that was a really important point that for folks looking at this graph, you're looking at the companies that we cover in our IT services vendor benchmark. And then Boz, I think sort of one of the things I heard you say basically is that in 5 years from now, as we're looking at the IT services and consulting space, the companies are going to be, the business models are going to be different. All of this is going to force that kind of business model evolution along with the adoption and scale of AI. So with that, let's talk about how some companies, or how companies broadly have positioned themselves. This is not, and I'll turn it over to the team here to cover this. And this is not, I just want to point out, you see the arrows. It's not like this is step by step, a linear progression, every company doing everything in that order. It's just sort of how we thought about what's been going on over the last really 3-4 years as AI has accelerated within these companies, and then what they're bringing out to the market. So Elita, I think I'll go to you first on this one.
Yes, thank you, Patrick. And I have 3 on this slide. So the first one
Excellent.
is around investments in IP people and startups. So IT services providers are investing to move beyond the AI hype. So we're seeing a clear shift from simply reselling hyperscaler and partner AI capabilities towards building differentiated IP, and really especially around industry-specific AI solutions and reusable accelerators. And this is critical because clients are no longer paying for experimentation. They're paying for outcomes. At the same time, we need talent. The talent strategies are also evolving. IT services providers are investing at the top end. They are hiring AI architects and specialists. And they're also reskilling their broader workforce to be able to industrialize service delivery. And then there's startups, acquisitions, joint ventures, minority investments that enable providers to close capability gaps. However, they come with integration risks, and there is also unclear monetization paths. So ultimately, the IT services providers that win here won't just invest. They'll turn those investments into repeatable assets that shorten sales cycles and improve profitability. The second item is pursuing new markets, especially the mid-market. Now, as IT services providers look to translate AI into revenue, we're seeing a shift in where they're going to market. The larger enterprises are still moving, but some of them often move slowly from pilots to the scale deployment. So providers increasingly are targeting the mid-market, where the decision cycles are faster, there's more appetite for near-term value. The mid-market is really important because the mid-market clients are now open to prepackaged, outcome-oriented solutions, and that creates a real opportunity for the IT services providers to productize their offerings instead of reinventing the wheel each time. But it also requires a different operating model. So it requires simpler pricing, faster implementations, and very often a heavier reliance on partners for reach. So the risk is that if IT services providers don't adapt their delivery model, they'll end up bringing high-cost enterprise-style engagements into lower budget segments, which puts pressure on profitability. And now, around alliances, we're seeing multi-partner alliances. This is the third piece of how IT services providers are working with partners. AI transformation is inherently ecosystem-driven. There is no single provider that can deliver everything end-to-end. As a result, we're seeing a shift from multi-partner alliances toward the multi-partner alliances that are bringing together hyperscalers and software vendors and increasingly niche AI startups. What's changing is that these partnerships are becoming much more use case driven. It's less about aligning broadly with a technology platform, but it's more about co-developing solutions for specific industries or business problems. And that requires a different capability, moving from traditional partner management to true ecosystem orchestration. We hear a lot of discussions about that, where IT service providers align incentives and IP and go-to-market strategies around multiple partners. It does add complexity and execution risk, but the IT services providers that get the right model we'll be able to innovate faster and deliver more integrated outcomes for our clients. I'll turn it over to Kevin for the next.
Thanks, Alyssa. Yep, I just wanted to quickly touch on customer zero listed there. The IT services and the professional services specifically, those vendors have definitely increasingly embraced that client zero, customer zero strategy. It strengthens both their own offerings and the market credibility when they do bring it out. This approach, really allows these firms to move beyond that theoretical value proposition and present more proven outcome-driven solutions, based on their own experience. The strategies, was used and became more common, during the shift to cloud and that as a service models. A prime example top of mind, HPE, it acts as its own, primary test case for its hybrid cloud platform, GreenLake. It put its entire global IT operations on the GreenLake platform before going public with it. HPE was able to, refine, its automation, its security, the consumption-based, financial models in that real-world enterprise environment, before scaling that offering to its global customer base. What does this ultimately mean for, the shift in AI? I anticipate that trend's, really only going to accelerate as adoption of AI grows. IBM comes to mind. They've been pretty vocal about, being client zero for their Watson X platform. IBM used it, to optimize their own internal operations, from finance, legal, HR, and beyond. Ultimately, that client zero strategy, builds confidence internally and trust externally. In an increasingly competitive IT services market, that battle-tested pedigree, it's becoming table stakes, for the firms looking to prove that measurable ROI, to their clients. And I'll turn it back over.
I'm going to wrap up the slide. Thanks, Kevin.
Yep.
So the last couple of blocks here are around people, right? Reorganization and product-centric discussions with the forward deployed engineers. So starting with the first one, I think what we're starting to observe in the market is some of the professional services organizations. Everybody's obviously facing the same dilemma. What my pyramid should look like? Is the pyramid? Is it an obelisk? Is it, inverted, versus, traditional pyramid? Just everyone's grappling with the same challenge. What we're observing in the market is that before any of that happens at scale is we're starting to see companies realigning their storefronts, right? They are reorganizing how they go to market and how they want to see their client, how they want to perceive by their clients and their technology partners. A slew of announcements over the last year or so from the Big Four, from the Accentures and others of the world that are really trying to position themselves, quote unquote, differently, and trying to optimize, their portfolio offerings, their skill sets. Putting a little bit of a cynical hat view here, often those companies, when they do those realignments, it's a good, front for them to, just optimize the pyramids, right, and get rid of, for lack of a better way to put it, letting people go that may not fit in the new narrative, right? So that's kind of the first way. So I think before those, whatever shape of the new organization is going to look like, it's the marketing kind of a view of the world and pushing the narrative like we are going to look and go to market differently. While there's a marketing component initially, I think the execution of that kind of a reorganization through the skill sets that they're putting in place will be how you measure success, how you measure the effort of all these reorganizations. And we're starting to see how companies are starting to develop different career paths for the talent that they're bringing in or they're hiring, or they're acquiring from acquisitions. Careers that are more product oriented and agent oriented versus maybe careers that are a little bit more AI sales driven, AI sales focused. Lisa talked about mid-market. What does that engagement looks like, when it comes to talking to those clients? And do you use more marketplaces? Do you need as many people? What's the role of the people that you currently have moving forward? So we are kind of that transition period as we see organizations making those announcements, reorganizing themselves internally, reorganizing their portfolio, their storefronts, and thinking about what does that mean to the rest of organizations. We've heard in the last 3 months from technology side, technology vendors, professional services vendors, everybody in between, talking about the usage of AI as a way of measuring and kind of part of the performance review of the talent, internal talent. While it is a good way for the organizations to bring up back to the board and say, see, we're using it, we're not just ignoring it, I think there is a potential fallback where the biggest question here to ask those organizations is, are your employees doing it for compliance or quality? Because if it's just for compliance for somebody to check the box, and if somebody didn't check the box and you let that person go because they didn't use the AI as much, that could backfire and lose some quality people actually can be used in a different way or be increased skilled and whatnot. And by the way, the technology that they're using for AI development, they're not perfect either. So relying solely on AI to tell you if your employees use the AI, that could be a problem as well. So compliance versus quality is I think is going to usage of AI is going to be a key element of measuring that success of those reorganizations that companies have gone through in the last 12 to 18 months. And the last piece is the product-centric discussions led by forward deployed engineers. This is where that transition really starts to put some concrete examples of how a company is doing things differently. How are they delivering services? How are they productizing their services? We know about the solutions architects. They have been kind of like in the core discussions between IT and business. Forward deployed engineers, one can argue that it has a very similar function, very similar kind of an idea between translating business to technologies and vice versa, right? What exactly is a forward deployed engineers? Is it just another term to do that, or it's something more? And time will tell if those FDEs actually make a difference, because if you need a fewer FDEs overall than used to use IT solutions architects, and your margin starts to increase because your overall pyramid starts to shrink, I think this is the biggest test if those FDEs investments will actually be paying off. So again, moving pieces, placing bets right now. We have started to develop here in TBR a index which we call Human Intensity Reduction Index, that is essentially measuring what exactly it says. Basically is the decline in headcount that is required for the per unit of revenue that those companies can output on a year-to-year basis. Are you really able to deliver the same amount of revenue or more profitably with fewer people? So it's an index that we start to track and see how companies are performing. Some are already indicating that they are ahead of the game. Some of them are a little bit more following the traditional patterns of their culture and what they really they're known for. But it's something that I think is going to be an index that's going to track and see that performance in the next 3 to 5 years and how successfully those companies execute on those initiatives. I'll turn it over to the next slide, if I may. And I think I kind of covered a lot of that already here. Just to kind of orient everyone on the phone, on the line, those two graphs come from our Voice of the Partner ecosystem report. One, it talks about the approach to multi-party alliances. The other one talks about the commercial models that vendors use. And we already touched on those. I just wanted to kind of share those as illustrative purposes on the outcome-based model being, as a top selective way of going to market with partners. And the one on the left talking about the multi-party alliances. I think the key element about the multi-party alliances that I wanted to add to what Lica was talking about is that historically, the bilateral alliances have led to the development of business groups or business units between a professional services company and an IT vendor and a technology vendor. I think we're going to start to see the advent of a multi-party business groups. Nobody has done it yet, but we kind of have our suspicions who may lead the way in terms of like the development and thinking about the orchestrating layer. That will put some more pressure, obviously. Everyone wants to be the orchestrator. Nobody wants to be the, the executor. But I think, companies will start to understand their role, especially as buyers are looking for vendor consolidations, and buyers are the one still paying the bill when they will choose to say, you're my orchestrator, you're the one doing, what you're good at and stay in your own swim lane. Obviously, that's going to put some more pressure on the orchestrator in terms of accountability, pricing transparency, commercial models, staffing levels and whatnot. But we're starting to see the opportunity being of a multi-party alliances business group as a way to think about what does the stack look like, because the enterprise level stack, IT stack, is well known. So vendors are starting to look and buyers are starting to look and see, do we need as many vendors, or who are the top vendors that can actually cover hardware, infrastructure, software, services, data. So now you start talking about like, do we need like maybe 3 to 5 vendors versus 12 to 15 vendors that often enterprises deal with for the various aspects of the IT services stack. And that, again, that graph is from the Voice of the Partner, where we survey groups across the OEM providers, cloud and software providers, and professional services providers. So those see the value in the multi-party alliances construct. Now it's about taking that to the next level. With that, I'll turn it over to the next slide, please.
Excellent. Thank you, Boz. And just want to pause for a moment, being mindful of time, and just recognize we got a great question in the chat. It says, do you see SaaS winners and losers? Will large enterprises continue to pay for SaaS that aren't systems of record? What else differentiates winners and losers? Great question. We're focused at the moment on IT services and consulting. We actually had one of our colleagues at TBR write a fantastic special report about the so-called death of SaaS, and he actually did a webinar on it as well. So we will, after this presentation, we will get you the details on that and connect you directly with the analyst, which is also a way of saying, as you hear each of the analysts talk about a bunch of the companies on this bubble chart, if you have specific questions, feel free to reach out directly to the analyst that covers them. This is probably the most, I don't know, in demand, the most looked at, sought after, and talked about chart that we do at TBR, looking at the revenue growth, the operating margin, and the size of the revenue, which is the size of the bubble. So what we're going to do now, this is the most recent one that we published looking at the last quarter of 2025, as all the companies have now finally reported. So we will turn it over. I think we're going to go to Kevin first, and each one of our analysts is going to cover a company, maybe two, and talk about, are they going to outpace and why, or are they just a curious company to look at right now because we don't quite kind of a mystery company. We don't quite understand where they're going. So Kevin, I'll turn it over to you first.
Yeah, thanks, Patrick. Yeah, I'll kick off here, try and keep it as brief as I can. A company that I cover and looking forward to 2026, Tata Consultancy Services, or TCS. To be blunt, I don't expect TCS to be a market leader in terms of revenue growth over the next year. The company's reported 3 consecutive quarters, year-to-year revenue declines in US dollars. Really hasn't seen double-digit growth since that post-COVID boom, say 2022. But that said, TCS is in the middle of what looks like a major transition. It's been gradually rewiring its major labor-based engine that it pursues the goal that it recently laid out in its earnings, which has really been a standout. It's to become the world's largest AI-led technology services company. It's a bit of a striking contrast, with TCS historically a conservative firm, often described as a fast follower, but yet it's speaking and acting, more like a forward-looking player. The company is it just talking about the change, or is it going to back up? Those are the things we'll be looking at, the investments, the workforce alignment, the platform bets that it's making, targeted acquisitions, so how much of this is, marketing, how much is real, so far, the numbers point to that real change. TCS, runs roughly about 580 some odd thousand employees. It posts peer leading profitability around 25% operating margin. And it has begun publishing actual AI metrics. Last quarter, it gave an annualized AI revenue run rate of 1.8 billion, total contract value of close to 9.3 billion, signaling genuine deal momentum, even as its overall revenue is a bit mixed currently. More importantly, TCS is acting, on the narrative that it's created. 2025, it cut close to 25,000, what it termed as, lower value roles. But while it's still upskilling 200,000 plus associates in advanced AI, the objective seems to be clear. Stop tying its revenue to pure billable hours, and more focused on that, sell that repeatable technology expertise, its IP, its ongoing managed services. It's a bit of a defense against that efficiency cannibalization, where automation and AI could erode those legacy billable hours faster than new services scale. to build that AI services, to build that credibility. TCS is investing across the stack, unveiling, a 5-pillar AI strategy. It's been embedding AI into platforms like Cognix and Wisdom Next, targeted M&A, just recently Coastal Cloud and List Engage. It's also struck a major infrastructure bet with its Hypervault to host high-density AI workloads. The challenge and, the opportunity is, finding that right balance. TCS has to monetize that AI and platforms, where the value is clear, while also preserving its competitive pricing and its delivery scale and its legacy modernization strengths. So in short, TCS is, trying to institutionalize AI at scale, where using internal adoption helps protect those margins, and it helps accelerate the transformation while still preserving its, core low-cost outsourcing roots. I'll go ahead and pause there and turn it over.
All right, so this is Jill again, and I also want to touch on CGI, which is outpacing peers in terms of revenue growth, largely due to its persistent acquisitions. Many of these have been in consulting, such as Stratfield Consulting. Most recently, also Aon, BGSS, and Doherty, which we expect will play an important role in the upcoming year, as we expect clients to lean more on consulting for realizing productivity from previously adopted AI tools, as well as global supply chain disruptions. As with many of the more onshore GSIs, we believe CGI will need to maintain strong client relationships, as many of its peers lean more on offshore resources and product as services, making the pricing environment more competitive. With that, I'll pass it off to Kelly.
Thanks, Jill. On this graph, I wanted to talk a little bit about T-Systems. I know it's often a forgotten company, but I think some of their recent investments have kind of shifted their position a little bit, especially as they're trying to differentiate themselves. While T-Systems is not really in an elevated position when looking at this graph, when compared to its peers, it's not really in a peer leading position, particularly owing to its lower operating margin. But the efforts that the company has undergone over the past few years has helped the company operate more efficiently. Some of these efforts have been around their data center modernization and business reorganization and consolidation. It's really helped T-Systems improve itself financially, so it has it's in a better position to invest in both geographic scale as well as some of their growth area technologies. While the company is primarily based in Germany, the restructuring efforts have enabled it to better reach clients across APAC and just operate better across EMEA in general. Deutsche Telekom and T-Systems launched the Industrial AI Cloud in Europe. It's planned to go live in 2026. But the main use of the platform is to enable AI across industrialization. And so this backs on its sovereignty expertise. Boz was talking a bit about compliance, particularly around AI and its importance. And I think this is somewhere where T-Systems really does set itself apart and well positions itself to work within regulated industries, including healthcare and public sector. It has continually deepened its sovereignty expertise as well as security, going back to another restructuring within the firm that helped it to better innovate across security and just better to offer more relevant offerings that are in line with growth areas and the changing technology needs. Additionally, the connection between the Industrial AI Cloud and T-Systems T-Cloud, which basically just has their existing cloud services, allows a more natural transition for its clients, and it builds that trust from start to finish with compliance as well as regulations and just the natural fit where data is not ending up where it shouldn't, it's remaining secured. T-Systems is also using a partnership with NVIDIA as part of this solution. Together, they are putting forth an investment of €1 billion to create an AI factory in Germany that's providing access to more AI portfolios for T-Systems and allowing them to deepen their technology capabilities. T-Systems is also launching a gigafactory that will help with their processing power and training surrounding AI and the different facets of the technology. The big advantage for T-Systems remain around sovereignty and data. The compliance and data residency has locational benefits for T-Systems, and it really aligns with their own strengths. T-Systems was not going to match the scale of its IT services peers over the next 3 years. Its ability to invest in growth areas will allow it to progressively grow revenue, and I think this is kind of where it's worth noting T-Systems, as well as their ability to offset legacy pressures. That's still weighing them down in traditional areas, but again, as they're focusing more on the growth areas and they're operating more efficiently than they have and strategically investing where staying in their swim lane, but focusing on the emerging pieces of it is definitely where T-Systems can set itself apart. And I will pass it off to Alitza.
To me, Kelly. Yes, thank you. So staying on the AI topic, so one example of how providers are positioning for AI-driven revenue is Capgemini's acquisition of WNS. This acquisition was completed in October. It was October 2025. It was announced in the summer of 2025, but this acquisition is a signal where the market is going, and it's showing that IT services are moving from pure IT services to AI-driven operations. So we used to cover WNS in the benchmark. We're not showing it any longer as a separate company. Starting 2025, it's being integrated within Capgemini. So the revenue and operating margin of Capgemini that you see on the graph includes 1 quarter worth of financials from WNS. So at its core, this is about moving beyond traditional IT services into AI-powered business operations. WNS brings to Capgemini deep domain expertise in business process services, also strong industry capabilities, and expands Capgemini's client base by adding over 700 enterprises. So WNS, in combination with Capgemini's consulting, technology, and AI capabilities, enable Capgemini to establish leading position in intelligent operations, which essentially is embedding AI, including agentic AI, directly into the business processes. So strategically, Capgemini is betting that the next wave of AI value won't come with standalone use cases, but the value will come with reimagined business processes at scale through AI. Financially, the deal is also designed to create synergies and accelerate revenue growth and margins. So we'll see Capgemini moving up in the top right side of the graph during 2026. It will be a gradual extension. It won't be a significant uplift, but it will be closer to peers such as Accenture and the India-centric providers. The risk, however, is execution. So integrating a large business process services player like WNS while shifting toward AI-led delivery is complex. And success depends on how quickly Capgemini can industrialize these capabilities and cross-sell them into its existing client base. So overall, this deal highlights the broader shift from IT services to AI-driven operations and from experimentation to scalable revenue-generating transformation. With this, I turn it over to Boz.
Thanks, Alitza. And maybe another vendor that kind of has maybe similar aspirations to Capgemini. Typically, a firm that is not part of our IT services benchmark, but we track closely here at TBR is Deloitte. And as you can see, it's pretty much kind of like not eclipsing from a size-wise, but growth-wise is very close to Accenture. If it was in the IT services benchmark, it will be the second largest vendor. It's right now NTT is and TCS is closely third. But Deloitte certainly has made its strides, and it continues to do so. I mean, when we look at Deloitte, obviously, they've been placing bets on IT services for a while now. But when we compare their consulting and systems integration revenue with Accenture, we actually see them bigger than Accenture in terms of that revenue size. Where Deloitte is still lagging, which impacts the overall size to Accenture, is their outsourcing business. However, that has been a key focus of the firm to expand. They're looking to drum up that business at least to be a quarter of the overall revenue, and it's certainly they've placed some bets. A few years back, they were not talking about BPO at all as a service line for them to be part of their portfolio. Now seems to be they're placing some bets, and we would not be surprised if a firm like Deloitte looks into an attractive, from a scale perspective, target the way Capgemini went after WNS to go after a company like maybe Genpact or EXL that are pure BPO players that could help them close the gap on that BPO front. Meanwhile, they're certainly placing bets on the ITO and the AO side of the equation from outsourcing perspective. They're really looking into their Silicon to Service framework and the launch of an AI infrastructure center of excellence are some of the recent examples of the firm that be investing heavily in product engineering services. So Deloitte on its own, while still part of the big four category in the group, is more like a GSI, like Accenture and Cap and IBM, the traditional big four, consultancy / audit and tax firm. So I would say that while again we don't track them as part of IT services benchmark, looking at their performance profile, looking at the investment profile, and some of the recent reorganizations, I hinted some of those firms have been going. Deloitte is one of those examples that recently reshuffled its EMEA operations, similar to the way it did the APAC operations 5 years ago, to more like a regional setup. I think it's and prior to that, they did that storefront reorg on their portfolio. So one of those firms that have placed some bets from a go-to-market, from a operating model perspective. Now it's all about execution. And I think they do have the view of the world and the connections and the network and the trust within the ecosystem, which plays a critical role that I could see them being, closing that gap on the outsourcing side very quickly as they continue to execute on what they call operate to transform framework, which is essentially using managed services as a lead-in to drive more consulting. And with that, I'll turn it over for any Q&A or any other questions that we may have on the line.
Yeah, boss, thank you. Thank you for wrapping that up. And as you can see, we could probably actually, can we go back to that? Just leave that slide up for a moment because we could talk about it for hours, but we're wrapping up now about every one of these companies. We did get two questions. The first one we'll tackle is what's the key driver of Cisco's high margin services? Kelly, do you want to tackle that one?
Yeah, sure. So looking at Cisco, a big piece of their margin performance remains around their channel partner strategy. For a very long time, they've been leveraging the channel partners to facilitate delivery, and it helps them keep those lower prices. They've also been accelerating the portion of software and subscription offerings within the Cisco CX business. So that just the nature of business is changing, which is giving them a boost in the revenue as well, or in the margin as well. They also are pretty diligent about their restructuring programs and how they maintain talent. So they constantly are shifting, so that way they have lower compensation within there. So it's a bit of a balance. They have a portfolio benefit as well as a talent piece. And then they also have a strong use of their channel partner strategy, which is that's the main driver that you're seeing the boost here.
Excellent. Thank you, Kelly. And then, and for the person who asked, if you have a follow-up on that, please feel free to reach out to Kelly directly. And then the other question we got was specifically to Boz about when we're publishing the Human Intensity Reduction Index. I have to say, it's the kind of thing that it sort of is answering one of the most important questions now, which is how are these companies here going to continue to generate profitable growth with fewer humans, basically. It's what all their enterprise clients are talking about, and it's something that's going to come for these companies, coming for them right now. Boz, I mean, I'm not sure what we want to say in terms of when we're going to publish, other than as soon as we can. Is there any other guidance from you other than as soon as we can?
There's definitely a very applicable publications. Probably Global Delivery Benchmark is coming around the corner. We'll probably include some of that as part of that product. We are in the process of developing other products that will be including, that index as well. But from an ongoing portfolio coverage, probably global delivery is the closest one. That's will include some of that.
Yeah, and I think we're probably going to look at the human intensity reduction index in the context not of every single company on this slide, for example, but in the context of the closest business model and scale peers when we look at companies in this space. So rather than trying to compare something like Lenovo to Atos or Ericsson to Cisco, we're actually going to look at companies that are more similar in their business model, because those are the ones that would be presumably going through some of the same similar business model disruptions in their endeavor to continue to make more money profitably with fewer people.